I'm based here in Austin. I work with a lot of early stage companies and startups and investors, and so a big piece of those are structured as convertible debt financings. I'm told that it's fundraising week with Mass Challenge, so hopefully I can give you guys some good content today. We're going to talk about some of the nuts and bolts. What is convertible debt? How does it work? What are key terms? And then also talk about what are some of the risks, intended consequences of running a convertible debt round without really planning it out well. So, agenda, we're talking about convertible debt, but it's good to think about what's the difference between debt and equity. Your convertible debt will be converted into equity, so you need to fundraise on. And key terms, what you'll. Then we'll lastly talk about the liquidation preference overhang, which is an issue that's come up. Well, it's always been kind of lurking in convertible notes, but it's additionally two ways for companies to raise capital. Obviously, we live in a world now where there's creditors that, or excuse me, debtors that have assets that have recurring revenue, and company. How do we put a price on what it is that we're trying to sell? And alternative debt, it looks a lot like traditional, and it's got a maturity date. I loan you $100. You don't want to repay me. You may not even have the means to repay me when that debt comes due. So convertible debt, the convertible and convertible debt, it's a conversion to equity feature. So basically how it works, you'll have your principal amount, it'll accrue interest. When you have and how do you convert it into equity? Well, you're going to use the per share price that is determined in an equity in the following equity round. There are other bells and whistles that come with convertible debt, particularly conversion discount for your investors that in their minds make a convertible debt investment worthwhile, and defer or punt on coming up with a valuation. Could be a couple of reasons. One, you could be really early stage, in which case someone says, we don't have revenue, we don't have assets, we don't have customers. This feels kind of weird for me to tell you what I think my customers, but you see on the horizon some big milestones that you're going to hit, and you think that, but you need capital now. And so with convertible debt, you can raise money and defer that conversation of evaluation to the later date, to the equity round. And if any of you are wondering, well, why do I even care? Why does it matter? Dilution of your company, meaning you get to hold on to more of it. So traditionally, convertible instruments are in the form of convertible debt, like I mentioned. Gaps?
Yeah, I want to ask about that.
The king in this type of fundraising structure, but you may have heard of SAFE, debt nor equity. It looks kind of the investor commented that a SAFE agree. You see it on the coast. I've done SAFE rounds in Austin, but they're rare. Creditors who don't want to be repaid, debtors who don't have any plan to repay debt, but investors still, they want the founders to feel like I've got 2 years to get to, are going to have a little bit more leverage over you. So, want to make sure that your investors are. I want to do a safe. Start over. Similarly, maybe you launch a safe round, you raise some money, you find an investor that wants to write you a big check, but they say, I don't do safes. Round and a note round. It's more complicated. You'd rather just be running one round. Oh, that's right, that didn't work. One other alternative. So there's a debt version, which is basically a convertible note, and there's that we already have. Even rarer in Austin, so just FYI, wouldn't recommend you go that route. Just a bit of terminology. It's an investment now that's going to bridge you to a future date when you can hopefully justify putting a higher valuation on your company and raising equity. Who uses these? Obviously, I mentioned pre-valuation startups, that company that doesn't have assets, doesn't have revenue, doesn't have customers. You're looking to do a Series B. Hit in the future, but you're going to run out of cash before you hit those marks. A bridge note is a way to kind of get some more cash on the balance sheet. Why? We talked about benefits of deferring a company valuation. Gives you the ability to hit proof of concept, a product, other KPIs and key metrics. From a timing standpoint, bridge notes are definitely easier and quicker than equity raises. If you've ever done kind of a full-blown equity raise and seen the documentation that comes with it, it actually, a handful of ancillary documents that are going to come with this, it just takes a little bit more time to pull together. With a note round, to each of your investors. I've seen it and hit all of your key terms. Again, there's less features to negotiate than an equity round. It also helps you maintain control of your company. When you're negotiating an equity round, you're going to be talking to investors about board seats, about voting. If you're doing a convertible round, some of your investors may. I'd like to do I'd like to have a board observer. I'd like a little bit more play in a convertible note round. To take one more, your investor gives you money. There's no timeline on when you have to repay that or convert it, and that's actually a reason why most Austin investors are like, "No, I can't do this. Like, I think you guys are great on my investment." Okay, key terms. I mentioned sweeteners for the investors, conversion, financing threshold. So the debt is going to convert on an equity round, but it needs to be like a legitimate equity round. It'll convert on an equity raise of X. Startups get sold and acquired all the time, even early stage ones. What happens if you're sold before you've converted the debt or it's come due? Different interest, 5 to 8%, not meant to be punitive, just a little extra juice for the investors. Term, I see 15 to 30 months. If you go low, you're going to find yourself in kind of constant fundraising mode if you go with, say, like a 12-month note. I've seen them where it makes investors anxious is that, say you do a 3-year note, in 3 years you might find, we're pretty profitable. I don't think we want to raise more money. I think we want to leave the cap table where it is. If we keep making money, maybe we can pay these guys off 5% over 3 years. So you can push for a 36-month term. You might get some pushback from investors.
Do you see pushback on 24 months? 2 years seems reasonable to me.
Yeah.
It's not to them.
I think 2 years is reasonable. Probably the sweet spot is 18 to 24 months is what I see the most of.
And what happens if you don't?
So, first 2 points up on that slide.
You want to see?
Okay. Well, again, not meant to be punitive. It should accrue. Yeah.
Sorry, I'll wait for it.
Usually the same price as these.
The interest. I mean, the interest is just.
It's another thing that has to be
Another annoying thing.
exactly. It's another thing that has to be calculated. Okay, cool. So yeah, that conversion discount. That's partly where investors are compensated for their risk and their cost of capital. Valuation cap. In terms of what's market, depends on the company. Put a value on its company yet. Conceivably, and this is like the most investors and say, hey, let's do a Series A. You'll put in $1,000. The Series A will have no right. You and me go do a Series B. And this prevents against, which again is a very nefarious example, but the note holders want to convert into like a bona fide equity round, right? Like they want to know that the company is raising real money so that it can go deploy its business plan. And then last, so what happens if before maturity, but also before conversion, you get a sale offer that you can't turn down? It'll get repaid first, principal and interest, but again, that's not the investment profile that your investors are looking for. So they'll negotiate for terms as to what happens on a liquidation event. Commonly, they'll ask for some kind of multiple. Hey, in other instances, they may say, actually, no, I want to convert into founders' common stock on a sale, and I get to participate in the proceeds. I want to be able to look at it before you sell the company, and I want to be able to pick whichever one is going to give me the best return. It's not really a material note. Conversion. Give me a percentage. Yeah.
But I think even the conversion discount is not that much
Yeah.
money, right? Because if
Yeah.
I'm a angel, I want a 10x return. And so the 20% is just like a very tiny sweetener compared to the cap. The
Yeah.
cap seems like the biggest piece of it.
I agree. Discount. Raise, it's at $1 a share. Based on your note. But a lot of investors say, no, conversion discounts, that's not enough. It's too risky. I need something extra, and that often comes in the form of valuation. The conversion price is going to be tied to the pre-money. If that valuation is higher than X, then you're going to convert me at the conversion price that would be derived from X. And it's common that they're included with conversion discounts, so you run both calculations and you give the investor whichever one gives him the most shares. So as an example, 10 million, let's say you've got 10 million shares outstanding, they're all founder shares, gives you a price of $1 a share. Your note holders, they don't convert at $1 a share, and they don't convert at 80 cents a share based on the discount. They get the better of the two, they're going to convert at 50 cents a share. So their $100,000 results in $200,000 worth of stock. And you're right, most angel investors are this example. Some risks and issues, equity rounds, there's still more to do, there's still more to come together, but they're definitely being streamlined. If you're together a lot easier and a lot smoother than perhaps they used to. Some preferred investors, they'd rather do equity. They're hands-on. They're like, look, I want to be a stockholder. I want to be on your board. I want to be helping you drive value. So that they may disfavor a convertible note round. What happens if nothing happens? We don't raise money. We don't sell the company. The debt comes due. I'm going to get to that in a minute. And there are instances where your interest and the founder's interest, or excuse me, your interest and the investor's interest can be misaligned, and it's related to what you were talking about, the return that investors are looking for, because your interest is in maximizing company valuation, right? You want to drive value, it'll give you a better sale price down the road, it'll help you from getting diluted when you're raising equity. If you're a note holder and you don't have a valuation cap and the company really drives value, that's actually not great for you, because it's going to drive up your conversion price, and it's going to mean when it is time for you to convert your note, you're going to get less equity in the company. It may leave an investor wondering, should I really just and be in a better position than I am now at this equity round. Okay, so what happens if you do a note raise? Let's say it's a 2-year note. You're scaling, but not quickly. You're profitable, but you're not necessarily killing it. And now your notes come due. So what happens next? I mean, you're in default, right? Like, you are in default under your notes. You file a lawsuit. It's a nuclear in the maturity date. And they'll say, well, we're willing to talk to you about that, but to do an equity round, and may leave you wondering, should I have done an equity round all along?
So if you can't service it, they can force you into bankruptcy, right?
Technically, yeah.
Okay.
I mean, it is a debt,
How does it work when you have multiple folks on the cap table? Like, I'm assuming not all investors work in concert always. So, let's say that someone wrote a $50,000 check, and they're the one who wants to push this.
Yeah.
What are the implications of that versus?
That's a great question. So, because of the scenario that I just mentioned, you really want to make sure that your notes can be amended by a majority in interest of your note holders. Mm-hmm. So if you can get a majority to the table and say, hey guys, we need to amend this note, all of these notes, the maturity date on all of them, that way you don't have someone who holds out and says, yeah, exactly. I'm going to file a lawsuit. I want better terms. I want this and that. A similar risk, what if you do a note round? Whenever you're looking for that hockey stick they still have some kind of conversion discount, and with that conversion, you're already being diluted because your valuation's lower than you thought it would be. And now you have these notes that are converting at an even lower price than that, so it's kind of like a double whammy of extra dilution, kind of bumping you off of the cap table. So just something to think about. Investors' perspective, in a lot of instances, investors say conversion discount isn't enough. My worry is that you guys are going to kill it. And again, I'll wish them first. I don't want to see, table, but caps, and that might be if you're going to $1 million no raise, 20% discount rate, and you agree to a $2.5 million valuation cap. You get to your Series A, you're going to raise $2 million on your Series A, but now you've got a pre-money valuation.
I've read through this and I knew it at one point, but I forgot just the pre-money and post-money valuation equations.
Sure. So
Maybe everybody else knows.
Post money is actually just take the valuation pre-money plus the money that you receive, right?
exactly.
Okay.
Yeah.
All right, yeah.
So you
That's what I
value
thought.
money that
Yeah.
receive another
Yeah.
500.
Standing, so your shares are worth it. Shares in your company are $12 million post-money valuation.
Okay.
$5 million valuation cap, and then you close. Okay. New money is a significant piece of the Series A. It's about 2/3. This looks about right. $2.5 million valuation cap on a $10 million pre-money valuation. Making this deal, like this is totally throwing off my investment model. I was expecting to be the lead investor, and your note holders have a significant piece of the round. They may also just find it like offensive that they're paying $1 a share and that you're converting at 25 cents a share. And also remember, if these investors are institutional investors, if they're VC funds, they have their own investors and they have to justify investments that they're making. And their investors might say, how could you do this? So what happens? The new money investors might say, look, we just can't do this deal at a $10 million valuation. So because of the terms of your notes, your new investors who may have otherwise been good.
What is appropriate in their mind for the new investors in terms of what the original note owners?
Yeah, so here's what I see is that the new investors say, look, you got to go to your note holders and you got to get them to amend these notes. If it's a valuation cap of 5 to 7 and we're investing at a 10 million pre-money valuation, we can probably live with that. But them investing at a price that's a fourth of what we're paying, we can't do that.
Portion of that pie for the note holders going back to the founders. They just don't want to see like these guys getting too good of a deal.
That's right.
Really?
Yeah.
Oh wow.
Yeah, and so then you go to your note holders and say, hey, we've got this awesome Series A investor on board. We're killing it. We're ready to do a deal. We struck. This was the risk that you agreed to. So it's a tricky place to be in, and I think the key is that you really want to model this all out, right?
How often does that really happen? Because it just seems like if the note holder knows who cares.
I wouldn't say it's common, but I would say that valuation caps are being asked for more by investors. I wouldn't say it's common, but I would say that valuation caps are being asked for more by investors.
Yeah.
And
Why would I ever invest?
Right.
that early.
But as a founder, you're like, well, yeah, I'm cool with that.
Yeah.
In the previous slide,
Mm.
how did we arrive at 10 million? Is that a random number?
Oh yeah.
What does that,
Agree to with your new investors, and you're gonna say, I think we're worth 10 million, and they're gonna say, I think you're worth 8 million, and this whole conversation, and the reason it matters is dilution, because at a higher valuation, you're gonna get diluted less, and at a lower valuation, they're gonna get to buy more stock, have a bigger piece of your cap table.
yeah, so that number,
Yeah, that's a great question. What often happens is investors and founders for the Series A will be talking, and the investors say, okay, fine, we'll settle on a $10 million pre-money valuation. And then the founders say, oh, by the way, we have these notes, and they've got a $2.5 million valuation cap. And that's when the investors are like, whoa, then I can't do this at $10 million because it's cutting into, it's taking such a big chunk of the cap table. We've got to either revisit the pre-money valuation, or you've got to go out to your note holders, hey guys, I'm sorry I gave you such a great deal. I need to walk it back a little bit.
so another thing that I keep hearing is, I don't know if this is a standard term, I'm actually getting ready to raise an ounce of this.
So a few slides back, 15 to 25%. This is pretty market.
Evaluation of the company at the next round. Can
That's
you comment on that?
That's a great point. So, I've said a couple of times really defer. Having that conversation. Valuation cap, you're not necessarily thinking about the valuation today, you're thinking about the valuation in the future, because it's going to come into play only when you raise equity. You got to start somewhere, right? And so what is the valuation today? So yeah, it kind of backdoors you into having that conversation.
But if you're less, then you don't get totally hosed, right? If you come in at a 1.5, be screwed. As if they had, anyway. We're always, anyway.
Yeah.
So how much of this applies to that?
All of it.
Okay,
Yeah.
okay.
Interest and maturity out the window on a safe. All
Add in the performance stock part, so that at the end of all of this, you're not left with like very little.
performance stock.
The buyback option for based on your performance at every round, you can buy back shares, right, for founder shares.
Who is looking to buy back whose shares?
So as you get diluted,
Yes.
when you achieve certain milestones, you have actually the option of getting back some of those shares. I don't know if it's buying back or they're rewarded to you as a founder.
Are you talking about like setting up an equity plan that's a negotiating point. Convertible note holders probably don't ask you to put together an equity plan.
Okay.
Series A equity investors do. Because they want you to put that in place before they invest, because otherwise if you do it right after, they get diluted.
Right, okay, so after your, whenever you're doing price round is when you should do that.
Yep. Okay, there's one other issue that I wanted to talk to you guys about, and it's a pretty nuanced point, and it's called liquidation preference overhang. So when you do an equity round, equity investors are going to ask for a term. It's called a liquidation preference, and it can take a variety of styles, but basically it means that those preferred investors get paid first before liquidation preference, right? It means they get their money back. the way convertible debt, and this also applies to safes, with the way they're written, debt holders or safe holders can get what is in effect a multiple liquidation preference because of how it converts. And kind of walk through this. So if you do $1 million note or safe, $5 million cap, then you do your $2 million Series A, again a $10 million pre-money valuation, and the terms of the Series A have a 1x liquidation preference. But if you're a convertible note holder and you convert it at a cap, which is 50% of the pre-money valuation, you effectively get double the amount of shares, so you get $2 million worth of shares. And here's where it gets pretty nuanced. The way equity financing documents are written, and this is how they're like all written, liquidation preference is tied to bet, receive a 2x liquidation preference. And so in the last few years, practitioners 1x is just that everyone gets their money back. This is a windfall for note holders and for note holders and safe investors often say, no, this is the deal. This is a solution is you issue what's called a shadow series. So how that would work is when the notes convert, the Series A cash investors say they get Series A-1. The note is identical, except that the liquidation preference for the Series A-1 is $1. It's tied to what they paid. But for your note holders, it'll be 50 cents. That way, if the liquidation preference ever gets triggered, everyone truly does just get their money back. No one gets some kind of extra return. There's no requirement that you give everyone the same terms, right? Your earliest note holders may say, I want a better discount, I want a better valuation cap. So what this means is you could have a lot of different investors converting at a different price. Series A1, Series that becomes pretty messy, right? And investors just could not wrap their heads around it. They just couldn't get it. They said, no, we're all converted to Series A. That's the deal. One other solution is an equity holder. So like in this case, they put in $1 million on the note. Overall, they're entitled to $2 million worth of stock, so you issue them the stockholders and only preferred stockholders. And again, in some of these deals, the investors just say, no, this is part of the deal. We're going to just do Series A. Shadow preferred, or the feature where they convert some into preferred and some into common, you definitely would want to put that in your convertible docs. Because if they're not in there, and then you get to conversion, and you go to your note holders and say, I want to issue you something a little different than what it says here in the docs, they may just say no.
Gotcha. Okay, so all this is language that goes in.
Yeah. So again, run a little over, apologies. You know, it's important to model this out. Think about what are your immediate cash needs.
I've had some people tell me that notes have been stacked. Like, what does that look like?
Yeah, it can be done. And it's very common for either your first money in. Your attorneys have to kind of make sure the documents work together because there are ways that they can be drafted that kind of put. It's not uncommon for, we see a convertible note round and it's and some people are converting at an even better cap, or excuse me, a better cap, a lower cap.
Mm-hmm. And then,
but it all of this would need to be addressed up front in the documents because all the stuff that kind of comes out later, and you're trying to bring note holders back to the negotiating table, they may just say tough. No.
I've heard of companies doing more than one convertible a bad idea to do that?
I don't think it's a bad idea. You just want to make sure that the docs that says that. Now, some savvy investors in your first note round may say, no, we don't want you doing another note round. Or if you do another note round, you got to give me, and you offer better terms, you got to give me the same terms. That comes into play more so in equity rounds. The issue with your note rounds is that if you issue notes and then you do a new round on better terms, your original note holders might just be pissed.
Once you've done a price round, after that everyone converts and you always have to do a price round. But I met a founder recently and she said they did a price round and now they.
So I talked about this a little earlier. That's common. Like say you're on an A and you're going to do a B and you're out of cash, or you're running out of cash, and you're not quite to some valuation drivers. You can do a convertible note round. Now, your equity investors probably will have preemptive rights, which means that they get to participate in the note round, like pro rata. So like, if you did a Series A and they bought 25% of the company, you got to offer them 25% of the note round. But there's otherwise no prohibition on following an equity round with a debt round. I see it all the time.
And then your next price round is when those people convert.
Exactly.
To buy out the note holders and completely screw them. Yeah, then it would be better just to lend the money and
Yeah.
pay off the
Yeah.
debt.
That kind of gets to the worry of like a 3-year note is like you find a way to actually pay it off, and your note holders are like, this was not what I had in mind.
Because I just feel like anytime the valuation seems like more than 1.5 or 2 the cap, everyone's incented to just pay the note holders off.
There's always a worry unexpectedly those note holders are really going to eat into the cap table.
Right.
Yeah.
How often does that happen? Selling based off the convertible?
The valuation cap is so low that it just gives people heartburn. Not as often. I mean, it's not on every one. It's probably less than half, but it does happen. And it'll probably start happening more because we're seeing valuation caps on less for bond investors and note rounds more often. Well, again, I want to be respectful of y'all's time. I hope this was helpful.
That's great.
I'm a mentor, so if you guys, you can find me on the dashboard. I think Aisha, is that where?
Yeah, the
Yeah.
accelerated dashboard.
Yeah, so